What's up everybody, Gen X Dividend Investor here. In this video I'm going to analyze a subscriber's dividend portfolio that was sent to me asking for my feedback, so I'll quickly go over their stocks and then I'll give you an overall rating of thumbs up or thumbs down. So if you appreciate videos like this, then please hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. Note I'm not a professional wealth manager, so don't take anything I say as financial advice. I'm just someone who is passionate about dividend investing, and I'm on a mission to educate the world on how amazing dividends are for passive income, and in their ability to help you retire early. Okay, I plan to run a poll on the community tab of my YouTube channel so that you can vote on this portfolio. That way we can see how everyone feels about it, not just me. In the last subscriber portfolio review I did, I said that I liked it, and then 616 people voted and 80% agreed with me. If you'd like me to review your portfolio in a future video, then Instagram me your dividend portfolio, as well as info about yourself like your age, goals, career, retiring timeline, investing experience, etc., and then maybe I'll highlight it in a future video. If there's anything you don't want me to share publicly, then mention that as well. I have a bunch of people who've already submitted portfolios for me to review, and when I do these videos I don't pick them based on the order they were submitted, but instead based on what I think would be fun and valuable to watch. Finally, leave me a comment down below if you'd like me to do more portfolio review videos like this, and/or tell me your favorite types of videos are that I do. So today's portfolio came to me from a subscriber named John, who just started a YouTube channel called Vision 365 Financials. I encourage you to subscribe and watch his videos, as I like to support new financial YouTubers out there, because it can take a tremendous amount of time to grow a channel, as 99% of us don't have viral videos that explode your membership. Anyways, I'm going to share some background about John because he was cool with me sharing it with you guys. His name is John Klein and he's 23 years old and he works in the Navy as an electrician in Oregon. He's single and he loves investing and found out about dividend investing a few years ago. He also has published a few books on Amazon on gardening, which is another passion of his. One of his series is called Grow It, Yield It, which I was hoping would be about dividends, but is actually about strawberries, blueberries, and rhubarb. And another book he has called Successful Growing, which honestly could also be about dividends, but alas, no. I'll include some affiliate links to his books in the description of this video. As an Amazon associate, I earned from qualifying purchases. John said that when he first started investing, he made the classic mistake of not adequately researching companies and instead just bought stocks with very high yields. Side note, some high-yield stocks can meet your goals and could be fine for your portfolio given your needs and goals and risk tolerances. The reality is that chasing yields is a generic term, which often is meant pejoratively, but when you think about it, all of us dividend investors chase yield, at least relative to bond investors or to non-dividend stock investors. Anyways, John has a taxable account which he holds in M1, and he has a Roth retirement IRA in M1. I'll include links to his portfolios in the description of this video. His retirement Roth account holds the same stocks as his taxable account, other than his REITs which he only holds in his Roth. He said he's more bullish on Chinese stocks in the short term than on American stocks, and he thinks we're in for a correction. He also has a goal of owning some rental properties in the future. One thing I liked that John did was give us a lot more background info on him rather than just share his portfolio, so thanks for doing that, John, and congratulations for investing and for being entrepreneurial. Okay, let's go over your Roth now, since that's basically the same as your taxable. And kudos for you for investing in both a Roth and a taxable. He called this portfolio his all-weather dividend portfolio, probably named after dahlias. On the left of this picture is a screenshot of his Roth portfolio in M1, and on the right I show the sector weightings of VTI, aka the overall market. I did that because he categorized his stocks into 11 sector pies on M1, just like there are 11 sectors in the market. We see that he has 114 stocks in his portfolio, and his average weighted dividend yield is 2.706%, and his expense ratio is 0. So right off the bat, my first observation is that you hold more stocks than most experts would recommend that you hold. 114 is a lot. 20 to 30 is the average amount of what many experts recommend based on my research. I did a video called How Many Stocks Should You Own, if anyone is interested in hearing more nuanced thoughts on the topic. Now that being said, I personally know of successful investors who hold more than 100 stocks in their portfolios, and I know investors who have done poorly holding only a handful of stocks. So it's not necessarily bad, though you could obviously simplify your life and just hold a market ETF like VTI or VU or whatever. That many stocks makes it harder to stay on top of how each one is doing, which I found is prudent to do. But I can understand how it might be more motivating for you to hold individual stocks more so than an ETF, and that motivation might compel you to invest more. A nice thing you've done is gotten a higher yield at 2.7% than the S&P 500, which is about half that at 1.35% these days. Of course, you could also go with the dividend ETF that has a higher yield than the S&P 500, like VYM or SCHD or whatever, each of which has its own pros and cons. I talked to John about why he held so many stocks, and he said he likes to think of his portfolio as his own index, and he enjoys holding that many. He also said his portfolio's average weighted beta is only 0.66, and he likes the reduced volatility of it relative to the overall market. As I mentioned, he's segmented his portfolio into the 11 sectors, which I think is a good way of categorizing his various companies. But I'd recommend a couple tweaks. The first is that I'll just merge your transportation pie into your industrials pie, since transportation isn't one of the formally defined sectors, and normally those stocks go into industrials. The second tweak would be to break apart your communications technology pie into two pies, i.e. a communication services pie and an information technology pie. Doing those two changes would better align to the pattern that you were seemingly going for. Regardless, I like your idea of using sectors as M1 pies. Let's look at the target weighting of your sectors versus the overall market. A quick scan between your target weightings tells me that your allocations seem reasonable. Your tech percentage is a bit low, especially since you combine that sector with communication services. So like your communications and tech pie is at 14% of your overall portfolio, whereas tech on its own is about 28% in the overall market, and telecommunications is at 2.6% in the market, and if I combine those, then you'd be at 30% versus your 14% allocation. So my 2 cents would be for you to consider increasing your tech allocation to be more like the overall market, if not more. In the long term, I'm very bullish on tech, though I'm neutral in terms of what will happen in the short term. Moving on, we see you hold utilities at 12% versus the market, which is at 2.8%, but that can be okay. Utilities often lower your beta, so I can understand holding a greater percentage of them in your portfolio if you like low beta. Generally speaking, for younger people, I encourage higher beta, and then as they transition closer to retirement, I'd recommend they lower their beta. Anyways, it's fine for you to go heavier into lower beta, as you might be someone who isn't a fan of lots of volatility and such, and you'd rather lose less on red days and gain less on green days. Just realize that in normal market conditions, you'll probably be stunting your returns, but if we do have a recession here shortly, then you should hold up better than most. Looking across your other sectors, nothing jumps out worth mentioning. Okay, now let's look at your actual stocks, starting with communications tech. So Texas Instruments is solid, so is Broadcom, as is ADP. Amphenol is one I've not heard of before. It looks like they sell fiber optics. I'd be interested to hear why you got into that given the others you own here. Then Visa is good, Verizon's good. Oracle historically has been a good bet, though their top line growth could be more compelling. Cisco is good. T's just spun off WBD, and I think that each standalone one is more compelling than they were together, so that's fine. Intel is cool, and Microsoft and Apple are fine. It looks like you've set all your positions at 8 or 9% of this pie, which makes me wonder if you just kind of peanut buttered your desired allocation percentage rather than purposely did it. Like, I'd personally go heavier into Apple and Microsoft than most other positions, but regardless, that's fine. Let's jump into your utilities now, where you hold 19 stocks. I'll just call out a few of the stocks you have in here to keep this brief. So I see NextEra Energy, a couple water utilities, Southern Company, Sempra Energy, PPL, Duke, and Con Ed, amongst others. PPL used to have one of the larger dividend yields in the utility space, but management sold some UK assets and used that to purchase another company to improve their balance sheet as well as to have more growth in a geo they wanted. But they also unfortunately did a dividend cut, which obviously some income investors weren't pleased with, though some felt it was the right thing to do. Anyways, overall your utilities look solid to me. Now let's take a quick look at your 18 industrial stocks, and I'll call out some of them. They include Lockheed Martin, Illinois Tool Works, Honeywell, Cintas, Caterpillar, Cummins, APD, which should probably be in your materials sector, A.O. Smith, W.W. Grainger, Stanley Black & Decker, Snap-on, Dover, General Dynamics, and Deere. Solid stuff overall, though again a bit many for my blood. Next, let's take a look at your 22 consumer staple stocks. So Cisco, Pepsi, Procter & Gamble, Hormel, Kimberly-Clark, Smuckers, Church & Dwight, Colgate-Palmolive, 3M, which should be in industrials rather than staples, Archer-Daniels Midland, Walmart, Kroger, Hershey, McCormick, Mondelez or Mondelez, however you pronounce it, Kellogg's, General Mills, Costco, Clorox, and Coca-Cola, amongst others. Solid. How about your 9 healthcare stocks? So AbbVie, United Health, Sanofi, Merck, Medtronic, J&J, Bristol Myers Squibb, Abbott Labs, and Becton Dickinson all are reasonable. Now let's move on to your 8 consumer discretionary stocks. So Philip Morris is first, and that's actually considered a staple rather than a discretionary. Staples are products that people are unable or unwilling to cut out of their budgets regardless of their financial situation. Then you have McDonald's, Home Depot, Altria, which should also be in staples. Then Target, Lowe's, Leggett & Platt, and Genuine Parts. They all look good. Your next category is transportation, so like I said, I'd move those stocks into your industrials pie. So UPS, Union Pacific, FedEx, and Canadian National. Those are all solid companies. One observation is that since you own all the same stocks other than REITs in your taxable account, then it's good to be aware that Canadian National Railway is a Canadian company, and thus they should withhold 15% of your dividends for international taxes when they pay out. But since we have a treaty with them, then you should be able to recover that 15% if you file your taxes appropriately. I've never held any Canadian companies, so I unfortunately can't speak from experience on if that's how dividends and taxes work with them. I don't think you need to think about all that if it's in your Roth portfolio, because the 15% Canadian withholding tax that is normally imposed is waived for US retirement accounts. At least that's my understanding. Okay, let's move on to your 3 REITs. You've got Digital Realty Trust, Realty Income, and Innovative Industrial Properties. Those are all reasonable. Let's take a look at your material stocks. So first you have Waste Management, which is actually an industrial stock. And I'm not telling you all that to be critical, but just to be helpful. Then you have Stepan, Linde, Ecolab, Sherwin-Williams, and PPG. All good. Now let's take a look at those 7 financial stocks. So Aflac, Bank of Montreal, which is another Canadian stock to be aware of. T. Rowe Price, Royal Bank of Canada, Canadian Imperial Bank of Commerce, and BlackRock. Pretty much all solid. And finally, your energy sector. First you have Rio, which I think should be in materials, then Chevron, Canadian Natural Resources, ExxonMobil, Vail, and another Canadian stock, Enbridge. I don't know much about Vail other than I think they're an iron ore miner somewhere. I'd look into their taxation implications. Regardless, these all look reasonable. So one observation is that you don't have any non-dividend stocks that you shared. I'd encourage you to explore those to invest in as well. I wouldn't overlook a company to invest in it just because it doesn't have a dividend. So something like Google is one that I've advocated for my kids. Anyways, so even though I like most of the stocks in your dividend portfolio, I'm giving it a thumbs down for me because I'd rather just go with an ETF and get some non-dividend stocks. That doesn't mean you need to change what you've done, nor does it mean what you're doing won't work out great for you. Ultimately, since you're young, I'd focus on companies that you think can grow your net worth the most, dividend or not. Of course, the most important thing here is not what I think, but instead that you're investing, so congrats on starting so young. I'm very confident that if you don't quit, you'll blow by where I am. Remember, live frugally and invest for decades in quality companies. Don't waste your money on sports cars or brand name crap. Just invest. Okay, now I'd like to shout out my latest Patreon aristocrats who have recently signed up. So thank you Shays, thank you Ricardo, thank you Bill S, who signed up for an entire year, which gives him a 10% discount. And thank you Raygoon1920, who also signed up for an entire year. He's actually a teenager who's been thinking about starting a finance YouTube channel. When he told me on my Discord that he was planning on signing up to my Patreon, I told him to save his money and invest instead, but he said he talked to his parents about it and they were cool with it. He also said that he actually started dividend investment accounts for his parents because of my channel, so that's great to hear about a younger guy pushing his parents to invest and them allowing it and appreciating it. If he does start a YouTube channel, I'll tell you guys all about it. Aristocrats gain access to my dividend portfolio tracker spreadsheet, which I use in lots of my videos, and they get special access to various private channels on my Discord, including one which lets you watch my videos before I release them publicly on YouTube, as well as lets you vote on which thumbnails I should use, and of course you get more direct access to me. Finally, I urge everyone to join my free Dividend Discord chat server, which has thousands of dividend investors on it from around the world. Please hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. Thanks for watching, stay positive, and I'll talk to you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.